All right, welcome to our explainer, where we're going to break down one of the biggest days for the Indian stock market, Union Budget Day. We're going to cut through all the chaos to figure out what's real and what's just noise.
You know, you've really got to understand that on Budget Day, there are two totally different games being played at the same time. For most retail traders, it feels like a lottery ticket, right? A shot at getting rich quick. But for the big institutions, it's the complete opposite. It's an exercise in managing risk.
But to really get a handle on what's happening today, we've got to rewind the clock a bit. See, the market's reaction to the budget isn't some fixed thing. It has changed a lot over the past decade. It's almost like its personality has evolved.
And you can actually map this evolution across three very distinct chapters. First, we had the era of reformist shocks, where huge surprises sent massive waves through the market. Then came the capital expenditure pivot, when the market started rewarding smart government spending. And that brings us to today, what some are calling the non-event era, where things have become, well, a lot more predictable.
So back in 2018, during that shocks era, the market took a huge dive. But here's the thing, it wasn't just about the new tax itself. The real problem was what we call a trust deficit. The government broke a kind of unspoken promise, and if there's one thing the market hates more than anything, it's a bad surprise.
And this number, 14, is just so important here. Think about that. For 14 years, investors operated under the assumption that their long-term gains were tax-free. It was baked into everyone's strategy. So pulling the rug out from under them wasn't just a policy tweak. It was a massive psychological blow that really shook confidence.
And then the market's mindset started to change. This is where the capital expenditure pivot comes in. Investors got smarter. They started asking how the government was spending its money. They started paying attention to something called the fiscal multiplier. See, every rupee spent on subsidies actually created less than a rupee in growth. But every single rupee spent on infrastructure, on building things, that created 2.5 rupees of value for the economy. Now that is an investment the market can get behind.
Okay, so this brings us to the big question. How does the smart money actually play this game? Because large institutions, they aren't gambling. No way. They have a precise playbook, and it's all about strategy, not luck.
Their first tool, their secret weapon, is the India VIX. You might have heard it called the fear gauge. All it does is measure how much volatility or how many wild swings the market is expecting. And like clockwork, it spikes right before the budget as everyone gets nervous. But here's the key. Institutions don't fear this spike. They trade it. They use a strategy called the volatility crush, and it's this brilliant three-step dance. Step 1, they just wait. They let all that pre-budget fear and uncertainty drive up the price of options. Step 2, the second the finance minister finishes their speech, they sell those super expensive options. And why then? Well, that's step 3. The moment the news is out, good or bad, all that uncertainty just vanishes. The fear premium gets crushed, it collapses, and they get to pocket the difference. And this quote just nails it. This is the genius of their strategy. They're not betting on whether the budget is good or bad. They couldn't care less. They are simply betting on the fact that once the speech is over, the chaos dies down and things go back to normal. It's a bet on the return of certainty itself.
Their other major play, it's all about getting there first. Weeks, sometimes even months, before Budget Day, they're already moving their money around, rebalancing their portfolios. If they think, say, solar energy is going to get a big boost, they're quietly buying those stocks way in advance. So by the time you and I hear the word solar in the speech, they're already sitting on some pretty nice profits.
All right, so we've seen how the pros do it. The big question is, what can the average retail investor do to navigate this storm and not get caught in the traps? Well, here is a simple playbook. The first, and honestly the most important rule, is the 70-30 rule. It's simple. You protect 70% of your portfolio. That's your core, your long-term investments. Don't touch them. Budget day is just one day in their long journey. The other 30%, you keep that as cash, ready to go.
So what's that 30% cash for? Well, think of it as your ticket to a flash sale. It's a weird thing that happens, but often, even on good news, the market will take a quick dip because all those early players are taking their profits. That's your moment. That's when you can use your cash to buy great companies at a temporary discount.
Okay, now this is a huge one. This is a trap you absolutely have to avoid. So many retail traders buy these cheap hero or zero options, hoping to hit the jackpot. But the reality is that volatility crush we just talked about, it's a killer. Because even if you guess the market's direction right, the value of your option can still go down as all that fear and premium just evaporates. It's a tough lesson to learn.
So after all the speeches are done, all the analysis, all the chaos on the screen, what's left? At the end of the day, the market gives its final, clear verdict, and it's all based on one single number.
And that number is the fiscal deficit. Now, don't let the name scare you off. It's a pretty simple idea. It's just the gap between what the government spends and what it earns. That one number tells the entire market everything it needs to know about the government's financial discipline.
And the market's reaction to this number is almost scientific. It's an if-then statement. If the deficit is lower than what everyone expected, that's a signal of discipline. Bond yields tend to fall, which is fantastic for banking stocks, and the whole market usually rallies. But if it's higher than expected, that sparks fears of inflation, maybe interest rate hikes, and that can send the market tumbling.
Now, sometimes you get a special case, right? A bit of a twist. For instance, say the budget falls on a Sunday when there's a special trading session. Well, all the global markets are closed, so there's less money flowing around. This low liquidity can mean that price swings get really exaggerated, both up and down. On a day like that, you'd be watching specific sectors, like defense or space, very closely for any surprise announcements.
So, what's the ultimate takeaway from all of this? What's the one thing you should remember? I think it comes down to this quote right here, which captures the perspective you need to have. The budget is a signal for the next year, but it's just noise for the next few hours.
The real challenge for all of us is to look right past the minute-by-minute chaos and focus on the bigger picture the budget is trying to paint for the whole year ahead. So the question you really need to ask yourself is this: when the dust settles, are you going to be someone who trades the noise or invests in the signal?